Good afternoon, and welcome to the Gatewood Wealth Solutions weekly market commentary broadcast. This is John Gatewood, and with me today is our Chief Investment Officer, Aaron Tuttle. Welcome, Aaron.
John, thanks for having me again this week. I don't know why you keep letting me come back.
You know, for whatever reason, you keep coming up with brilliant stuff. That's why we keep having you come back. But also with us today is a special guest, George Russell. George is one of the institutional investment managers for Franklin Templeton, and George is a seasoned CFA, Chartered Financial Analyst, the top certification in the portfolio management world. But George manages the Franklin Templeton Small Cap Growth Fund, which we recently added to our model portfolios. Welcome, George.
I'm glad to be here. Thank you very much.
So we're going to begin today with a brief update on the economy and market from Aaron, and then we're going to follow up with comments and observations by George Russell. And following that, we're going to move on to Q&A. So take it away, Aaron.
All right, I think a lot of our listeners are very familiar with the slides today, and I'm going to quickly run through them. So it'll be the standard slides, and that way we can spend a little bit more time with George and answer any of those questions that clients have. Daily deaths are now consistently below 1,000 per day. What we are watching for a spike in new cases, given the reopening of the economy and the protests. Currently, the aggregate new cases are steadily declining. Headlines of states that are rising are really low population states that really never had a big outbreak. So they're more headline scares from what we can tell, because they're coming off a very low number. The CDC data, we've looked at that, still is peaking in mid-April with a total of 92,922 deaths reported. We have seen some headlines insisting Sweden is a hotbed. We have not seen a significant change relative to other countries with large cities at this point. So yes, Sweden is near the top with the United States and France, but really nothing statistically out of the norm. Recession. Early on in this correction, we were on record saying that we weren't quite sure that we would hit that technical recession because of the way that you calculated over two negative GDPs. This caution proved wrong. Well, we are in a recession. It is official. According to the National Bureau of Economic Research, the U.S. economy peaked in February and entered a recession in March, ending the longest economic expansion in history at 128 months.
Wow.
However, these are lagging indicators, and often the recession data comes in as the expansion is already starting. And we believe this is the case. The New York Nowcast was significantly positive in the weekly data. The surprise was due to the ADP payroll, and that was the reason for the jump. We do believe the current unemployment benefits will slow employment recovery, so we don't expect to see consistent jumps in this number. Shape of the recovery, we continue to follow that V-shaped recovery. And unlike the recession call, or at least the cautionary call of saying it may not end, the V-shaped call has been proven correct so far. We're nearing the January 1st opening value of the S&P 500. We did break through the previous week's resistance level, and now we're at a new resistance at 3250 on the S&P. This means we're getting close to new highs, which is likely the next resistance level if we make it through 3250. It's going to be interesting, John, to see if we can make new highs off of such a steep historic sell-off.
Absolutely.
We continue to lower our overweight to U.S. large cap, specifically our technology weighting, and we're using those proceeds to go down the market cap. We've changed our overweight to U.S. large cap to now an overweight of the U.S. domestic market. These changes have been based on our relative strength ranking process, and most of the year we've been hiding out in that U.S. large cap with the S&P 500 near the top of the table. Looks like we're off a slide here. Whenever you look at the S&P 500 is now somewhere below average. So it's in the lower end where technology was above and gold was above. Those were the only items that are above. We can now see mid-cap core and small cap core are near that top. And because of that, we're starting to move a little away from technology, still above the S&P 500. We did get rid of the gold position and increase that mid cap and small cap exposure. So that is where this slide was supposed to come in. So sorry about getting those mixed up. The theme, a declining dollar. Another thing that we are seeing, sold off again today. We're still within a trading range, but the dollar has lost a lot of value this past week whenever you're looking at the typical movement of currencies. So we're going to continue to monitor, but really a move to the small and mid cap does help against this risk because if it persists, the small and mid cap companies have a lot of their sales domestic. They'd also look a little bit cheaper international, so they could benefit from that. But if we were to see that happen, we would likely increase our emerging market exposure at the expense of U.S. large cap. So John, I'll turn it over to you and George, and we do have some slides here from Morningstar Direct on the fund he is going to be talking about.
So thank you, George, for joining us. We'd like to hear some comments from you in terms of what you're seeing out there in terms of the market, what you guys are doing with your fund. So tell us where you think we're going right now and thoughts that'd be important for our listeners to hear today.
Great. Thank you very much. I thought I would do three things today. One, give you just a little bit of our thoughts on the economy, then talk about our process just so you understand where we're coming from on the small cap growth strategy, but really spend most of the time describing what we've seen in this market environment and where we have our portfolios positioned at this time. In terms of the economy overall, our view is that we are in what I've been calling a bumpy square root. So basically, what does that mean? Obviously, a big drawdown, as Aaron mentioned. We're in a recession right now, but we are likely, barring some second wave in the fall, we are likely now in the recovery period because obviously the economy is opening up right now. The recovery, we can't really get back to the same levels of GDP that we saw in 2019, probably until at least next year, if not 2021, because people are not going to really have the same behavior as they did 3 or 4 months ago until there's a vaccine. So we get a nice recovery off of the bottom, but not 100%, the V-shaped recovery. And then we have continued moderate economic growth through the back half of the year and into next year. And then I say it's bumpy because obviously there's going to be a lot of volatility in the market as we balance what's going to be some pretty bad numbers in terms of GDP and earnings, but also looking ahead to the economy recovering. And the market, of course, discounts the future and is already looking into 2021 where things should be much, much better. So there'll be that balancing act of current numbers looking not great overall, but looking ahead to significant improvement. So bumpy square root is where we are in terms of our economic outlook. That's
certainly
economics comes in for us.
The statement that the Federal Reserve issued today for its FOMC, and it said that it's committed to using its full range of tools to support the U.S. economy, thereby promoting maximum employment and price stability. Aaron, they also said that there would be no rate increase through 2022. And I'm directing this question to you, as unemployment does recover and prices do begin to rise, which we expect will happen at some point, what can we expect as a market reaction to this, assuming that the Fed truly remains accommodative for such an extended period of time?
Well, they certainly can remain accommodative. The previous interview with Chairman Powell said that they have basically an infinite balance sheet. So that's certainly the case. We would expect them to continue to really pour money into it as long as it's still sluggish and they're below their inflation target. But our view is that really the Fed is operating or looking at this from a model that failed in the 70s. They seem to have this idea that there's a trade-off between unemployment and inflation, that you can't have one or the other. And we know from the 70s that you can have high unemployment and you can have high inflation.
Stagflation.
Stagflation. And you had what was called a kind of a liquidation event whenever government bonds are paying below inflation. And this is one of the reasons that we've been leaning towards equity and really only keeping that fixed income in there as a ballast for the portfolio to try to pull some of that volatility out, because there's just not much growth there. Now, whether the Fed can actually achieve this and whether inflation causes them to pull back and move, it really is beyond 12 people on a board can't really understand or be able to foresee this. But the Fed does have the capability of keeping interest rates low.
So one of the things you had mentioned earlier is that we sold our gold position in favor of home builders,
Yes.
and but we keep talking about inflation as one of the key risks to our future portfolio management, just to our clients' wealth, right? So at what point would we change the portfolios to become more inflation protected specifically, and what would be the triggers that you would see for that?
So we've been using our technical indicators and trying to rank and understand the momentum and really where money is flowing in the economy. And that was the reason we sold gold in exchange from the home builders. That's the reason we're moving away from our very significant overweight to technology to add some mid and small cap exposure. And that's based off just watching how the different asset classes, different securities are performing relative to others. If we were to start to see inflation, we're likely to see those asset classes, whether they're commodities, real estate, items that should do well during inflation, and there are plenty of stocks that would do well as also. So we're waiting to see that the market begins to forecast and we get a little momentum in those asset classes before we want to take a position. You know, coming out of 2008, there was still a very strong Chicago school emphasis on money supply and understanding that if you increase the money supply by a certain amount, you would get inflation. A lot of people went into assets like commodities expecting a lot of inflation, which never showed up. There's reasons, we've talked about those on previous calls, on how a lot of that money was really a reverse repo where it just wound back up on the Fed's balance sheet as excess reserves. We don't think that is the case this time, but it's really very difficult to say, no, inflation is going to be this amount and be able to make those allocations. We're going to wait for the market to really start to give us a signal that as a collective group, you know, we believe in active management, but we think that a lot of people start to see that and build those positions, and we pay attention to that, and then we would begin to move portfolios towards that direction.
Well, it is interesting that we see all these gold bugs out there that they follow the Rand Paul theory of holding assets, and how there's been a rush to gold all of a sudden during this crisis, and we saw the same thing back in 2008. We saw that in 2018. So
and
whenever we have the market reacting or going down, there is that natural reaction for some reason.
And yes, Rand Paul and his father, Ron Paul, follow an Austrian school, and they definitely tend to favor gold. But gold is cash. It is not a company. It's not generating a revenue. Doesn't mean that it's a bad thing to own. It's a really good thing to own. But it's not just Rand Paul or Ron Paul and some of the late night commercials where they're trying to sell you gold while you make poor decisions late at night. Bank of America, which is Merrill Lynch, they have come out strong with gold, and they make a valid point, right? You can't print gold. You can continue to print U.S. dollars. And when we look around, yes, every central bank is doing it. The Federal Reserve, whenever we measure the money supply, is doing it at a more rapid pace. So it's not an insane position by any means to expect this and kind of get ahead of it. It just doesn't mean that inflation is going to show up. And if it doesn't, then gold is just going to sit there. Now, compare that to bonds with very low yields. They're kind of just sitting there too.
So one of the other things you talked about was that we're watching closely is the value of the dollar.
Yeah.
What's causing the dollar to decline right now?
Well, when we're looking at money supply, we like to look at other central banks, and since the correction, the way that we calculate it, and it's annualized, there's about a 46% increase over the last 13 weeks in the non-seasonally adjusted money supply for the U.S. In comparison, the European Central Bank is just a little over 10%. And that isn't too surprising, considering before this started, we had significantly higher yields on U.S. Treasury versus, let's say, other European bonds. And now they have kind of come into parity. They're very close. That spread has widened. That carry trade was unwound early on. We did a call on that. So the dollar is probably losing value because relative to other currencies, at least in the short term, there's been far more dollars created than other currencies. Now there probably is going to be a pretty big demand for U.S. equities, so it doesn't mean that the dollar is in a secular decline or anything like that. We're still in the trading range, but we definitely want to pay attention to that. Franklin has some really great European funds, and one of the things they do is just hedge out the currency risk in those portfolios because the currency valuation changes can really change your overall return whenever you have to put that into a different currency. You may be up 12% domestically in that region, but if the dollar has gained against that asset by the same amount, you're not up anything.
Well, it looks like we are out of time. And so first of all, I want to thank you, George and Aaron, for your very informative comments and observations. And so as a reminder to our listeners, that was George Russell. George is one of the institutional portfolio managers for Franklin Templeton. He's a certified financial analyst, chartered financial analyst. And he works within Franklin Templeton's small cap growth fund investment management team. They have an excellent team. They have 30 analysts on that team doing an excellent job. But I do want to remind our listeners that any discussions around any specific stock or mutual fund is not an endorsement to buy or sell, but simply commentary based upon each of our commentators today's opinion. And all investments have risks, so past performance is not indicative of future results. So that being said, I want to remind everyone that these weekly broadcasts are open to the public, and we welcome the opportunity for you to share the links to our broadcasts on social media or with your friends and family, as they are more than welcome to listen in and learn our perspective on the market and the economy. So thanks again for listening into today's broadcast. Thank you again, George. We look forward to future conversations. And as always, if you have any questions, please contact your lead advisor or any other member of our team. We are here for you.